Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Windsor webinar series. This program is entitled Spotting Promoted Tax Shelters in the Real Estate World, Best Practices and What to Avoid. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 events or so I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You could read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Matthew Rappaport, who's Vice Managing Partner at Falcon, Rappaport, and Berkman based in Long Island, New York. Matthew chairs the firm's taxation and private client groups, where he focuses his practice on taxation as it relates to real estate, closely held businesses, private equity funds, and trusts and estates. He advises clients regarding tax planning, structuring, and compliance for commercial real estate projects, all stages of the business life cycle, generational wealth transfer, family business succession, and executive compensation. He also collaborates with other attorneys, accountants, and financial advisors, bankers, and insurance professionals where they encounter matters requiring a threshold level of tax expertise. Matthew is known for his work on complex deals involving advanced tax considerations such as Section 1031 exchanges, the Qualified Opportunity Zone Program, freeze partnerships, private equity mergers and acquisitions, and qualified small business stock. He has served as a trusted advisor for prominent real estate funds, executive of multinational corporations, venture capitalists, successful startup businesses, and ultra-high net worth families. Today, he'll be speaking on spotting promoted tax shelters in the real estate world, best practices, and what to avoid. And with that introduction, I'll now turn the program over to Matthew.
Yoni, thank you so much. It's always great to be here. Although now I'm looking at the attendees pour in and I think I have like extra pressure. There's like a dozen people who are better lawyers than me. There's people I do business with. And then there's clients of the firm. So I have a lot to live up to and I only have a half an hour. If I have time, I'll give special shout outs to a lot of people that are on. And I'm very glad that we have such strong attendance at these things. Okay, so Yoni read my bio. Everybody knows the title because Yoni does an excellent job promoting these programs and giving everybody really in-depth information in advance about what this is all about. I have to scroll right by my ugly face or everybody will turn to stone. Standard disclaimer, this is not legal advice, not tax advice. Please don't implement any of this, then come back and sue me. So really briefly, before I get into the content, I'll lay out the topic today by describing, I think, the overall environment in terms of tax planning and the the fringes of what is actually allowable. There are a lot of people out there with a lot of different strategies that are varying levels of blatantly illegal, kind of illegal, borderline illegal, and it kind of concerns me, which is why I put this deck together. This tends to be particularly rampant. The targets for people that are promoting these schemes are people who are selling real estate and people who are selling businesses. I focus on real estate today, but some of the things that I do talk about are relevant for people who are selling businesses. And I get questions pretty often. I probably get questions 15 times a year from centers of influence with whom I do business, and they tell me, hey, I have a client who is selling a building. I have a client who is selling her business, and she has been approached, and she says that she can really get ahead on the after-tax consequences of selling the building if she engages in this particular technique. And the center of influence will call on me to vet it out. The question is, can the person do this? And really briefly, in 25 minutes today, what I'm going to cover in surface detail is, what are the stakes if your client does this? What are certain things that I see out there that are not okay? And why should you avoid them, and what kind of characteristics can you spot in some of these things that would lead you to do further investigation or outright avoid some of the stuff that people are coming to you with. That's what today's presentation is all about. So let me try to cover this as thoroughly as I can with the time allotted, right? Form 8886, reportable transactions, okay? This form is required anytime that you have a transaction that meets one of these 5 categories. I have these 5 categories discussed in further detail, or at least some of them are discussed in further detail later in the slides, because some of them are self-explanatory. Listed transactions and TOIs, or TOIs, transactions of interest. These are out there in IRS guidance. You can search these on Google and you'll get to the official irs.gov page that lists all these transactions. Here's the thing though, what's covered under these categories is not only the transactions that are described in the individual notices. These notices have been coming out for about 25, 30 years, right? The thing is, however, the statute not only covers those transactions described by notices, they also cover the transactions that are quote unquote substantially similar to any transaction described. And that's a key concept because a lot of these promoters will come out with variations of transactions that have been listed and they're not distinct enough in order to avoid these penalties. So the penalties and the disclosure requirements, but you've got transactions that are confidential, meaning that any transaction that subjects you to an NDA where you can't disclose this to any other party. Of course, as a matter of public policy, you can't have an NDA that says you can't disclose transactions to the government. But any transaction that's got confidentiality protection, it falls under these the statute and regulations. Transactions that have guarantees in them, meaning we guarantee a certain tax result. These are rare, right? But I guess they exist. If you have a promoter come to you and tell you, satisfaction guaranteed, we will get you the tax result you want or else we'll reimburse you. That falls under a reportable transaction. And then you have loss transactions, which above a certain threshold, right? It's a numerical threshold of losses. There's a different threshold for corporate taxpayers and non-corporate taxpayers. If you have a transaction that generates a certain amount of losses, that is reportable. And the transaction, it's not your typical transactions that come up in the regular business world. Like if you have a Fortune 500 company that has to write down portfolio of mortgage-backed securities or something, and it has to sell it and has to take a massive tax loss. That's not really what they're talking about. They're talking about transactions that on their own generate losses without any real purpose in the ordinary course of the taxpayer's business. Okay. And I've seen examples of these get promoted by folks, and I can start running them down, but time allowing, right? But the thing is, Form 8886 is required. Pretty much any taxpayer who engages in these listed transactions is required to file it. The thing about it is, right, as most of you know, if you're in the tax world, regular old statute of limitations on auditing a tax return is 3 years. If you have what's known as a quote unquote gross income misstatement or gross valuation misstatement, you can extend that statute of limitations on income or potentially transfer tax returns to 6 years. So your regular statute of limitations is 3 years. Your extended is 6 years in certain circumstances, 25% of gross income, 25% of a valuation misstatement, that sort of thing. You can extend the statute and kick up the penalties potentially. But Form 8886 is a different animal. If you have a reportable transaction, but you didn't report it with this form, the statute of limitations extends like forever, because you did not adequately disclose the nature of the transaction to the service. So even if you reported it through other means on your tax return, that's not enough. You want to know why? Because Form 8886 goes straight to a special unit in Utah called the OTSA, the Office of Tax Shelter Analysis, and they will take a look at your return if you file Form 8886. If you don't file Form 8886, the OTSA is not necessarily notified, and that's the reason why the statute of limitations really continues to run. It's a policy thing. So whenever you have a reportable transaction, you must disclose it on Form 8886, otherwise it continues to run, and this is no good, right? Here's what the instructions set forth, which based on time allotment, I'm not really going to get into in major detail, right? But here's your penalty. So you have a Form 8886 requirement. You have to disclose it. Section 6707 Cap A actually goes ahead and sets forth the penalties, and these are painful, okay? 75% of the decrease in tax reflected on the return. So it's really effectively a 75% penalty with a max. It's got a cap on it. 10 grand for individuals, 50 grand for other taxpayers, right? And there's also a minimum. So it's either 5 or 10, It's 10 or 50, depending on the nature of the taxpayer. 5 to 10 for individuals, 10 to 50 for any other taxpayer. But even so, it's painful, right? But let's also keep going, because besides 6707 Cap A, the reportable transaction failure to disclose, you could additionally fall under Section 6662 Cap A. That's an additional accuracy related penalty, right? So you've got a 20% accuracy related penalty under 6662. What does that penalty say? That penalty says, hey, if you did not have the strong enough authority, right? And I don't know if any of you are familiar with levels of confidence in terms of when you take a tax position on your return and trying to get out of a penalty. But under normal circumstances, you have a substantial authority threshold, right? Substantial authority is basically defined as any authority you have supporting the transaction as or the position you take as actually being legit. That authority is substantial in comparison to any other authority that says that it's not legit. Substantial has never really been defined. A lot of people ballpark it as a 40% chance of success. That seems about right. But substantial authority is the bare minimum, but there is a kicker in the event that you meet certain conditions. So substantial authority is you take a regular old tax position and you're evaluating it and you say, you know, what can I do in order to take the position with a certain amount of confidence and not get slapped with a penalty if it gets reversed, right? Taxes and interest you really can't avoid. If you get a position reversed, that's it. Taxes and interest, right? But the Section 6662 penalty says you didn't have substantial authority at minimum, but there are 3 thresholds of confidence above substantial authority. There's more likely than not, pretty self-explanatory, better than 50-50 odds. Then there should, which is really anything that's between probably just above 50%, right, all the way up until the 85% range. And once you get above the 85% range to the 90 to 100% range, you get to the will level of confidence. Will isn't a guarantee it's going to work. It's just that it's so unreasonable to think that the position would be reversed that you're in pretty safe territory there, and it would take an extraordinary event to have that position overturned. Will opinions are really saved for like securities disclosures and inducing certain major institutional parties to undergo a transaction, things like that. Most opinions are more likely than not or should. To avoid the 6707A penalty and the 6662 Cap A penalty, you need more likely than not rather than substantial authority, which is important for you to understand, because you're going to need some serious justification that the position works in order to get out of this stuff. So looping this back to the penalties, 6662 Cap A says, in addition to the 20% accuracy related penalty, we're going to slap another 20% on you for a grand total of 40%. If the transaction has been listed, okay, so there's, remember, there's, going back to this, 5 categories of reportable transactions. If it's listed, okay, a listed transaction has now a 50% penalty, all right, which is crazy. So you really, really want to avoid these. It also, Section 6700 also penalizes the promoters. One of the other things that you should be aware of is the promoters are subject to what's known as the John Doe summons. The John Doe summons says we're not going after the taxpayers who engaged in this. We're going after the promoter first. And the promoter then discloses the entire client list. And the promoter now gives the IRS the gateway to audit everybody. And if that sounds really ugly, that's because it gets really ugly. So the stakes are really high. And the reason why it's important to focus on this is because you have to understand sort of the landscape behind this. You can get a lot of trouble for engaging in these transactions. So let's go into, just for one moment, what these transactions actually are, right? Number one, intermediary installment sale transactions. These are like pretty popular. I actually have a client right now who is engaging in one of these against my advice. The transaction has not yet been listed, interestingly enough. So I think it's a promoted tax shelter, except it hasn't been listed, so you're not subject to all these crazy listed transaction penalties, but it's still pretty bad. How does this transaction work, right? Let's go ahead and say I'm selling a parcel of real estate and I'm looking at the tax hit and saying to myself, like, man, oh man, this is painful, right? I'm selling a parcel of real estate for $10 million. I got a very low basis, right? Maybe there's a building on it that's been depreciated to nothing. So In an intermediary installment sale transaction, somebody comes to me as a promoter and says, hey, you got a buyer lined up for your $10 million parcel of real estate. When you have to pay federal, state, and local capital gains taxes, you're looking at like a third of that going to the government. Isn't that painful? Wouldn't you like to invest that money pre-tax and pay the tax in dribs and drabs, potentially knocking you down to a lower tax bracket in the process? And this could become particularly relevant if Build Back Better somehow is revived from the dead, and you have these super brackets where if you have adjusted gross income or taxable income of over, say, $5 million in a given year, you end up with an extra 5% marginal rate. These things could knock you down in brackets. And intermediary installment sales basically say, look, I got a promoter here who's willing to take the parcel from you and give you an installment note. And then the parcel goes to the ultimate buyer for cash. The intermediary keeps the cash, and they keep it purportedly segregated enough from you that it's not taxable to you. Instead, what's taxable to you is the installment note. So you're paying your taxes in little dribs and drabs. And in the interim, you get to control indirectly how that lump sum of cash is invested as it's held by the intermediary. Sounds like a great deal, except for the idea that the control that you exercise and a couple of other technical aspects of the intermediary installment sale make it such that it's really taxable to you. To give you an idea of what those technical aspects are, right? 453E. If you do this with any party that's considered related to you, right? That could be in a trust. A lot of these things are done through what are known as deferred sales trusts. If you truly have a trust vehicle that benefits any member of your immediate family, 453 Cap E is going to apply, and it's going to take the installment method away from you by law. So those don't work. I've never understood why people think they work, but they don't work. Some other promoters are corporations, right? So 453E might not apply, but you got a revenue ruling down here that I listed for the tax heads that are attending. You got a revenue ruling 77-414. You've got the Wren decision. That's a Supreme Court decision, right? Both of those suggest that if you have an intermediary who does not have an economic purpose for being in the transaction, that transaction is going to get thrown out, which is bad times. Then you got 7701 and this statute is in the code. It's been in the code, I think, like 20 years, and it's a very general provision that basically says, hey, if you have a transaction that, number one, doesn't change your economic position in any meaningful way, and number two, you don't have a legitimate non-tax purpose for actually engaging in it, we're going to throw it out. And 77010 has not been applied that often. Haven't seen it applied in audit that much. I haven't seen it really there's a couple court cases that deal with it. But most times when the IRS sees something that's abusive, they try to attack it in different ways before they go to the statute. But don't forget about this, because in instances like the intermediary installment sale transaction, they may bust out section 77010, and they may tell you, hey, listen, this promoter who came in and got in between you and your ultimate buyer and gave you a note, they didn't give you a note for any other reason than improving your tax position. So we're not respecting this. And you may well fall into that pit and end up having your transaction overturned for that reason. So again, right, the 77010 opens up a no-fault penalty under a different subsection of 6662 than the normal penalty. It's got, an economic substance penalty under yet another subsection. So you could have section 77010 apply to this. It could really apply to any promoted tax shelter, but the IIST is no exception. And in general, if the whole thing sounds a little bit too good to be true to you, probably is. And that's one of the characteristics that you can look for, where you say to yourself, listen, I got to go to an expert and I got to investigate this further, because if it ends up being a shelter, then my client and I can both get into some hot water. Syndicated conservation easements. Oh my goodness gracious. Does the service hate this? Congress hates this. Everyone hates this. The promoters are very well moneyed. So what the promoters have done is the promoters have turned around and they've really tried to take this all the way to court. They've tried to launch collateral attacks on all of the different provisions of the code and the regulations that deal with this, the the administrative guidance, all that stuff. And it hasn't really been successful. It's been very, very rare that any of this has been successful. And for most of it, it's been successful where the promoters have not been pigs about what they've been doing. How do these things work, okay? Conservation easements allow you a deduction under Section 170H. And what conservation easements are is they are a modification to the deed of your land that basically says you can never develop on this land. You have to conserve it environmentally forevermore. It has to be perpetual, right? And the deduction is based on the fair market value of the actual easement and the change. So in other words, if you go ahead and you put an easement on land that's worth, say $10 million, you get $10 million worth of deductions. So somebody comes up with a bright idea and says, hey, what if we pool together a bunch of investors and we buy a parcel for $5 million? Then we go in and after, say, a year, we go get an appraisal for what the parcel's worth, and ta-da, the parcel's worth, $14 million based on highest and best use. Sounds bogus, I know, but at the same time, that's what they've really been doing. And then what they say is, well, now we have $14 million worth of deductions that are funded with $5 million, potentially through leverage as well. So you may have $1 million worth of investments come in cash, $4 million worth of debt to buy the parcel, and then you take $14 million worth of deductions, and you're now putting in $1 million cash for $14 million of deductions, and the leverage is very, very high. So that's been attractive to a lot of people who have income from another source, and this generates a very, very high deduction for them. These got listed, okay? That's Notice 2017-10. These got listed. The commissioner of the IRS, Chuck Rettig, who is a former private sector guy, by the way, he's not, previously the commissioners have really been lifelong government folks, but not Chuck Rettig. Chuck Rettig is a private sector guy. So if anybody was going to be sympathetic to the private sector trying to go out there and make money and create economic value, it's this guy. But he came out and said, no, we do not like this, okay? The amount of times I've had clients approached by these that I'm aware of in the last 5 or 6 years. I mean, dozens. And this is a couple of them are even after they were listed, okay? So the listing notice really has deterred a lot of these promoters because they've set aside litigation budgets and they've really made a lot of money from this. So they don't want the party to end. Do not let your clients get caught up in this, okay? Because if they do, they're going to end up a target of not only the IRS, but also the Department of Justice. And, nobody wants to be in this kind of hot water. It's really, really, really painful. And you have some unscrupulous people out there who just don't care. So syndicated conservation easements fit this theme of like, I don't get it. I'm putting $1 in, I'm getting $14 of deductions back. It seems too good to be true. That's because it is. Charitable joint ventures are a little bit more clever, right? This is a Notice 2004-30. Taxpayers got an S corp. They recapitalized the S corp into voting and non-voting stock. Taxpayer keeps a voting stock, so they control the enterprise. But they take the non-voting stock and they go ahead and give it to an exempt organization, right? A legit 501c3. I mean, something that's really actually licensed to get charitable deductions and run a nonprofit and all that business. But the scheme here is that the non-voting interests are skewed, okay? There's outsized compensation that's being paid to the taxpayer, for their services. There are loan arrangements that make it such that a small amount of money goes to the exempt organization for its trouble, and most of the real economics go to the taxpayer, right? And by hook or by crook, they're borrowing the exempt organization's tax exempt status to get a lot of cash without paying the taxes on it. And that is, that's patently abusive. So the notice was about S corps, but you see this a lot with LLCs because LLCs are more flexible. S corps require one class of stock. You have to do all the economics pro rata, right? And in an LLC, you can, it taxes a partnership. You can start playing around with allocations and things like that. and it makes the scheme even more aggressive. In March 2019, there was a defendant who was convicted of tax fraud, and that involved the Charitable LLC. And there's some stuff out there where I see you've got some real estate that goes into a joint venture. It's joint venturing with an exempt organization. The exempt organization may be the equivalent of a private foundation. It might be a charitable remainder trust. It might be, a couple of these others. And again, the results are just too good to be true. And these charitable joint ventures are gaining a little steam and popularity. Loss creation transactions. For those of you who have been practicing long enough to remember Son of Boss, you can go look up what Son of Boss was. This is a major accounting firm I will not name, right? Because it's just impolite to start highlighting. The people that perpetrated this at those firms are long gone. But Son of Boss is an example. The Midco transaction created losses. There's a couple of these other things that created losses out of thin air that allowed you to get losses. And what they would say is, well, there's a loss and there's an offsetting gain, except the loss is taken right now and the offsetting gain is delayed indefinitely into the future. That is the sum total of what these transactions look like. I've seen it recently with an option scheme. There was an option scheme going around where through a very exotic option transaction, there would be a large amount of, the taxpayer would have to part with, like, if you wanted a $10 million loss, you'd have to part with like $2 million in cash up front and then leverage $8 million. And, that's a popular one. And I saw one of them presented to a client of mine, and I was just like, this is insane. Like I said, you can't get into this because this is gonna land you and the promoter in an orange jumpsuit. So believe it or not, these happen. Okay. Let's get to stuff that's a little bit more gray. Cash out Delaware statutory trusts. Those of you who have ever been involved in the 1031 world with any level of depth, you know what Delaware statutory trusts are, and you generally understand what the 7 deadly sins are. This revenue ruling says if you have a Delaware statutory trust that doesn't obey each of these 7 prohibitions, you risk the idea that the Delaware statutory trust is treated as a partnership and therefore not eligible to accept 1031 money. One of those prohibitions is you can't refinance existing loans. So how do these Delaware statutory trust transactions work? You have a taxpayer who comes into a Delaware statutory trust investment and then goes ahead and leverages their Delaware statutory trust interest, or sometimes the DST itself has a new loan lined up in order to go ahead and give raw cash without paying tax back to the investor, okay? The thing is, right, under 1031 law, if you have any cash received as part of a 1031, it is taxable as a matter of rule, right? DSTs turn around and say, well, we're doing an instant refinance, so it's not really cash as part of the 1031. So the 1031 rules don't tax it. But what about the 7 deadly sins? Well, the loan is really lined up. It's locked and loaded. It's not really a refinance of an existing loan. So you don't have to worry about that particular prohibition. And I have come to the conclusion personally that you can't have a 1031 investment into a DST that both avoids receiving cash as part of the exchange, treated as boot, and avoids the prohibition against refinancing existing loans. There's one that does it really clever, where they have an affiliate of the DST sponsor, the institution that's managing the investment, and the DST sponsor will, through its affiliate, give the investor a loan against their DST beneficial interest. Clever, but man, is that towing the line, right? I'm going to skip premium financing because I have 2 minutes left, right? Gen split dollar. For those of you who have been following along with this, Gen split dollar was interesting insofar as they leveraged an insurance split dollar arrangement between Generation 1 and Generation 2. And what they would say is the split dollar arrangement, which generates a receivable that goes, it's held by Generation 1, payable by Generation 2, right? And the payment of the receivable is determined really by a trustee for Generation 2. Promoters are basically setting it up and saying this receivable is subject to a valuation discount when Generation 1 dies, because it's a receivable that has to be discounted based on a number of factors associated with the split dollar arrangement. This went to a bunch of different cases, which I have here: Morissette, Cahill, and Levine. Those actually in the early stages, the taxpayers started winning on a couple of technical issues, and they got killed on valuation. They got killed. And the generation split dollar, I think, has basically started to wane itself away as these cases have started to go to final resolution, because the valuation, just the results didn't get where they wanted to go. But on a lot of these different technical issues, believe it or not, the taxpayer actually won. So you could see how clever some of these were in their design, but inevitably there's a pitfall somewhere when the transaction's abusive, right? What can you do, right? In terms of, a lot of people tell me there's a lot of stuff that's illegal. So what can you do that's legal when you watch out for these things? Of course, you have regular Section 1031 exchanges, QOZ investments, split interest charitable trusts. Qualified retirement plans, when they're done right, are magic. Like anytime somebody comes to me and says, I'm paying too much in taxes, what should I do? You should do a qualified retirement plan first if you don't have one optimally designed. Optimally designed, by the way, means you go to an actuary. As much as I love TPAs and financial advisors, you are not supposed to be designing retirement plans. You're supposed to go to an actuary. Cost segs, don't do them abusively. Captives, micro captives are very abusive, right? You have to have captives done for legitimate reasons and through legitimate vehicles, but they work if you do them with somebody with integrity. But if you've got somebody who's a promoter, it's going to be bad. It's a listed transaction, by the way. And then in estate and gift, you got FLPs, crummy powers, leveraging crummy powers, slats, ILITs, a lot of free stuff: 2701 partnerships, grants, grantor trust, charitable strategies, donor advised fund, private foundations. And then look, the other thing before I leave off is backdoor Roths, before they pass Build Back Better, which is currently like on life support, and Joe Manchin's about to pull the plug. You can do backdoor Roths still, and they're very, very powerful. And if you have clients who are in the position to do a backdoor Roth, it's one of the most powerful things you can do for estate and gift. And Bruce Steiner's on here, so you can always go to Bruce Steiner, who is smarter than me by a factor of 17. And he is one of the reigning experts on all things Roth IRAs and conversions and things like that. So they're very powerful, and you should do them. So Yoni, you take back over and send everybody off. I hope it wasn't too quick, but some of this stuff is really dangerous, and you should at least know about it when you're out there, because it's a jungle.
Great. Thank you so much, Matthew. It's great as always. If anyone has any specific questions, or new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Matthew or myself where appropriate. I'll be sure to include his contact information in the follow-up email to this program. In case you missed it, the handouts to this program were sent out in the reminder email to this event. I will also send them out again tomorrow morning. As I mentioned at the onset, the goal of all these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on Thursday, February 10th on estate planning misfires of the rich and famous, Philip and Helen Wrigley, featuring Daniel Studin, a partner at Morris & Cohn, based in New York City. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.